So thank you very much for joining us for this session. Still in the game, is scale critical? My name is Anne Byrne and I'm an independent director on the board of Lucrative Super. This afternoon we have three wonderful speakers. Raywin Williams from Parametric, Robin Petro from Energy Super and Richard Brandweiner from First State Super. I'm not actually going to read out their CVs, you can find them on the app. So is scale critical? My question is, critical to what? Critical to investment returns, better member services, lower costs? Or does increasing scale mean that the fund becomes all things to all people, losing its personality and attractiveness to its core or original member base? Or is small and nimble better able to supply better member services, investment returns and manage their costs? Or is this discussion totally irrelevant? As long as the fund has reached a reasonable level of scale, it can do whatever it wishes. So let's go to our first question, which is in fact the second question on your app. So if you go with that, you can tell us, for a fund to have scale to survive, how much money do they need? So it's the second question on the app. You all know where the app is? You know the name of the session. And I have to... Oh, there... It does appear that the majority of people think it's above 5 billion. Or 5 billion and above, should I say. The regulator also has a view on this issue, and they ask superannuation funds to confirm that they have sufficient scale. And we'd like to know how often you think that should occur. So now go to the first question. Should that be required to be done annually, every 3 years, every 5 years, or there shouldn't be any sort of mandatory timeline? Looks like every 3 years is winning. That might be some interesting feedback. Okay, let's now go to our speakers. They'll have about 5 minutes each. Raywin has some PowerPoints, and there will be no other PowerPoints after that. They're very good PowerPoints, I've seen them.
Thank you.
5 minutes each.
All right, thank you very much. So my job is to set the scene for today. I'm not giving you any answers, that's not surprising, but to really tell you why scale is an important debate in the strategic landscape for super funds, and also share with you some of the ways that I'm thinking about scale and suggest how we may not be thinking about scale in the right way in terms of this important industry debate. So, as we just heard from Anne and was said in the question, scale is now a viability issue for funds. There is an annual test that's been inserted in the SIS Act for funds effectively to demonstrate that they are large enough to remain in existence. So the stronger super reforms have really upped the ante on the scale debate. So what I want to do today is bring it back to the mission, to use not-for-profit language, the mission of funds. Now, we all know what that is. We've got Energy Supers and First State Super, so Richard's and Robin's missions from their websites there. These are just interpretations of the fund's sole purpose test that's set out in the SIS Act. The reason that I've got this slide in here is that I want to remind everyone that whenever we're talking about something like scale, the end is not scale. Scale is a means to the end, and the end is, or our anchor, that we should be bringing everything back to is the fund's core mission, which is delivering these retirement outcomes for people. So let's remember in the context of this debate that it's not scale for scale's sake, it's not low fees for fees' sake, but it's all about whether we can prove that these things are actually helping funds deliver on their very important core mission. So where does scale fit in? When I was asked to speak today, I spent some time reviewing the comments in the Cooper report from 2010 and the more recent financial services inquiries reports. I found it really interesting that there were a lot of comments about scale and scale benefits, but there seems to have been a real starting premise that scale is beneficial to the industry and to members, and the focus went straight to why the scale benefits haven't flown through to members. Now, I find that interesting because I think it missed a whole lot of setup debate, and that was, well, what do we mean by scale? Is scale really beneficial? Are there downsides to scale? Is it really as simple as saying the bigger a fund can be, the better off members can be? So I think a lot of that was lost by these reports moving pretty much straight to that starting premise of scale should have delivered benefits and hasn't. Why haven't funds been delivering these benefits through to members? So when I think about the benefits that have been isolated in the scale debate, the one that comes to mind for everyone is lower fees, and we have seen some evidence proffered around this clear relationship between lower fees overall and more scale. So we do see that. But I think that again is an illustration of the fact that we're not necessarily extending this argument through to what really matters. So even if we accept that being a larger fund means we can deliver on our core mission at a lower cost, does lower fees per se really mean that we are delivering better retirement outcomes? So if we have funds that are bigger and can reduce fees, have we then sort of taken that next step to show that those funds and their lower fees have been able to deliver better retirement outcomes to people? And that's this anchoring back to a fund's core mission. So I think that we're developing the first part of that argument around fees, but I don't see enough on the second part of the argument, which is equally important, which is if we accept that we are delivering low fees or can deliver low fees, does that actually result in better retirement outcomes? So part of that is actually stepping back and thinking about scale and saying, well, there's been an awful lot of talk about the benefits of scale, but are there costs, are there downsides to scale? And I'll show you in a minute my own list of how there are pros and cons, if you like. And I think that you could all make a list like that. So before I show you my list, really if you take, if you give yourselves 5 minutes and you were to jot down a list of desired attributes for a fund and the industry in general, it might look something like mine. It might be a little bit different, it might be a bit longer if you've got more than 5 minutes. But I think the key point is the same. You list a whole lot of things like I've just done here, and then next to it you say, well, are each of those things actually helped by being larger, or are they actually hindered? And what I suspect you'll find, as I found, is that it's a mixed bag. So some of the things are actually helped by being larger, but to my mind, some of the things get harder to deliver. For example, member centricity and really knowing your members, and I think ability to innovate. Some of those things seem to actually get harder once you move up the scale curve. So I just want to finish with a couple of more, I think, academic observations, and then moving right to the other end of the spectrum, a couple of really practical suggestions. And these are just suggestions to I think, liven up the debate that we'll have after my presentation about how we could be thinking about scale and the sort of questions that we're not really asking yet that would help us. So I start with the concept of economies of scale. So I feel a bit sheepish, sort of taking everyone back to Economics 101, but we see this glib expression, economies of scale, where are they, why aren't we being delivered to members? We see it all the time in the scale debate. But let's actually talk about what we mean when we go down this this path. So what I've got sort of on your top left there is sort of a standard economies of scale curve. Not that as a speaker I'm allowed to use graphs, but if you just think about on the y-axis having size and on the x-axis having cost, that top left curve there just depicts economies of scale. So literally as you get larger, you're able to reduce your per unit cost. So we're all sort of comfortable with that. But of course, if we're talking about economies of scale, we also have to think about the possibility of diseconomies of scale. And that's when the curve becomes a U-shape. And we know that that can happen in some industries. And while I don't know whether it happens would happen in the super fund industry, we're not actually asking the question, we're not putting that into the debate about whether this curve's actually a U-shaped. And I want to go further and say, well, there are a couple of other nuances that we can bring to the debate. The first is the concept of a minimum efficient scale, and that's depicted by the base of any of these U's. So that's the idea that you can, as a fund, get down as you grow to a minimum cost of economically producing your output. And so my question is, are you does this pathway mean that on the sort of far right-hand side, you're one of the trajectory you take means that you can get down to that minimum efficient scale quite fast? So that's an important thing for you to know as a fund. How quickly can you get down to that minimum efficient scale and down to that base? Or is it actually more like, say, that bottom curve where it actually takes you a long time to get down to a minimum efficient scale, in which case there are more funds that should be worried about that period and how long it will take to get there. And then the second thing I'd throw into this, and again I'm just rifling through my economics textbook here, is to say, well, if there is technically this minimum efficient scale, then how big is the base? Is it a sort of a very narrow base, meaning that there's a very small sort of pigeonholed size of fund that is efficient in an economic sense, and if you're outside that range, that very small range, you should be worried one way or another. Or is this concept of a minimum efficient scale actually more like the bottom U here? And that's important for the scale debate because it means that lots of funds of different sizes can play in this space. Lots of funds can get down to that minimum efficient size and show that they are pretty efficient across a range of sizes. So that's something I'd like to see more dialogue on. If we are going to talk about economies of scale, let's really talk about it using what we know about economics. Okay, so two examples, which will take 10 seconds each.
Quickly.
All right, okay. The first is to show that we can actually solve the pension segregation problem in a way that doesn't require scale, and that's in a research paper that I've published. And the second, similarly, it shows, based on research that we've published, that there's a way for smaller funds to get access to segregated accounts, even if they don't feel like they have their minimum account sizes. And the key message there, which is my final point, is that we think that some of the problems that we have in the industry need to be solved through scale and size, but they are both clear examples of how something different like innovative thinking is actually the answer and not scale. Thank you.
Thank you very much. So, Robin, what do you think about scale? Is 6 billion enough?
Well, yes, thank goodness. Thank goodness. Otherwise, I would have been redundant here today. I think what's really important here is that I don't think scale is anything new. I mean, it is a decision factor that every board and management team factors in there when they're making decisions, and strategy. Scale is a factor that it decides which way you're going to go and which path you're going to go down. So regardless of the size, you really are making decisions based on what you can and can't do. And one of the things that Energy Super look at as far as what do our members want. And, you know, Raymond put up our mission, and our mission is to help our members. And I think that's really important because we can. We're of the scale and the size to be able to stay connected with our members, and that's where that connectivity was. And we've got some very, very, very strong engagement numbers. And our scale really comes through because of our members themselves and the fact that they have account balances that are very large and are actually very active in our superannuation fund. We are small enough to be able to meet with our members on a regular basis. So for our staff members, the number of members that they have to cover is a lot smaller than a fund with 1 million members plus. So we are able to connect with our members on a regular basis, and we do so. And being within Queensland as well means that we are able to connect regionally, we are able to talk the language, and we are still considered an employee benefit for our members with our employers. So one of the things that has become very important to us is the relationships. But our scale and the way we look at economies of scale is really about the way that we're partnering with our service providers, which is a little bit different to what Richard's probably going to be talking about. But what we've seen and what we continue to do is to look for those partnerships. We partner with our members and we work with them to deliver their outcomes, to provide them with them educations, and to be there in their individual needs, and we can actively do that. Our economies come from the pooling of our service arrangements in both the administrations, and that includes processing and systems, custodian, and partnering with our fund managers, obviously. We keep all of our front-facing service delivery within the trustee structure, and that's where we find our strengths and our capabilities. Having small numbers of members mean we don't fall into the trap of trying to be all things to all people. In the investment space, we are fortunate enough to be big enough to be able to take advantages and to be able to co-invest as opposed to direct invest. We have seen co-investments, and we haven't had to deal with the capacity issues that some of the bigger funds have had to do. And we're smart enough in our strategy, but we have to be careful, right? And here's the downside. We have to be careful in our strategy. We have to be smart, and we have to select our next goals very, very carefully. This means we can't afford to make too many big mistakes. But again, we recognise that we don't have to be the first movers in a number of cases, and we can look for opportunities as they arise, and more importantly, learn lessons from other people. And I think that's where we really need to be the differentiators and be very careful from our scale. Our biggest challenge of the course is to try not to compete and try to be a mini Goliath, but to continue to listen to our members and our stakeholders about what is important to them. Pick the eyes out of the ideas being generated around us, and obviously maybe develop a few ourselves. And I think that's kind of the way that we're seeing our position in the process in the FOSWALs, and that's how we can manage scale to our advantage. All right.
Thank you. Don't forget that you can ask a question by using the app, but we will also have the microphone a bit later. So Richard is 53, I think. It has been
yes.
just too much, too hard to manage?
No, I don't think so. But it is hard to manage, however, but I don't think it's too hard. Obviously, there's more than one way to skin lots of cats, and I think the key in this discussion is around playing to the competitive strengths of a particular organisation and where you sit in that spectrum. First Aid Super's been on an interesting journey the past few years. So it was only a handful of years ago that our fund was less than 20 billion. And as a result of a big merger and strong inflows, we're now beyond 53. And what I thought I would do today is talk to you about the sorts of things that I'm able to do, or we are able to do now, that we weren't able to do before. And not make a comment on whether they're better or worse, or whether the outcome is better or worse, but just give you a sense of the positive things that have come as a result of strong and sustained growth in funds under management, and then also some of the challenges, and you can decide whether scale or whether large is better, in fact, or not. So in terms of the good things, I mean, the reality is that our budget is much more significant now. Our internal budget is much more significant now than it was in the past for my predecessors. And I should say, being on the investment side, I'm going to focus largely on how this applies to the investment world. But of course, as Robin said, it's much bigger than that. But the larger budget has a lot of implications, and probably the most profound is the number of ways it allows you to implement an idea. So I'll come back to that in a second. But if I bucket these things into three areas, the first is the operational platform that we're able to develop. The second is what it means from an investment perspective. And then the third is what it means from an alignment perspective. So if you just start with our operational platform, you know, we are able now to institute an institutional grade trading platform. We're getting the right data feeds in, we're off spreadsheets, we've got better pre-trade compliance. We're able to do our rebalancing in a much more robust way than we ever were before. We've now put in risk systems. We've signed up with Borough One. It was a 6-month project to get our whole portfolio, including all of our illiquid assets, into the system. And now we've got look-through reporting to understand our factor exposures across the board. It gives us much more flexibility than just relying on an asset consultant to do stress testing for us on an ad hoc basis, because we can actually play around with the data and look at the implications of different decisions on a live basis. And actually, most importantly, we've developed our own internal databases. We were heavily reliant on our custodian for things like performance reporting, other sorts of data. You know, it would come in static forms, it would come irregularly. Now we've taken control of that. We have monthly data series for everything that we need, and we're able to do a lot more analysis than we ever could do before. So I can sort of unequivocally say that, whatever that word is, that we are much more robust from an operational platform today than we were in the past. Second one is about investments. I'm paranoid about time here, Anne, so I'll hurry up. The second one is about investments. Look, the simple reality is we're in a position now where I can pay my investment team market-based rates of pay. So we have been pulling analysts and investment people out of the funds management community, out of the investment banking community, because the upside from a bonus perspective is not the same, but certainly the consistency and base pay is more than comparable. And that's quite a different environment from what we've found before. Secondly, that it's enabled me to increase the size of the team as well. And finally, and Raywin had some interesting stuff, it's a shame we didn't get there, about the ability to actually, use other tools to enable smaller funds to get, for example, tailored portfolios in retirement, but even just thinking about tailored portfolios in retirement, thinking about different types of equity strategies that make more sense in the income phase, retirement income phase, than in accumulation phase. We've got the luxury of resources and capability to be able to entertain those sorts of things. The final thing is about alignment. Having the size and the scale and the budget that we have has given us the options to execute on an idea in many different ways. So co-investments directly through pooled vehicles or through IMAs, through taking stakes in managers or seeding new capabilities. There's a raft of opportunities now for any particular idea. We're much closer to the market than we ever were before, so there's significantly reduced information asymmetry. And we're getting closer to the ultimate users of the capital that we provide on behalf of our members. And that reduces leakages, reduces agency risks, and hopefully improves returns. And then finally, when it comes to things like corporate governance, corporate actions, we vote and we act as hopefully a very active owner with the lens of the whole portfolio, not our listed property portfolio or our equities portfolio, with the lens of what's in the best interests of members. And that's something we couldn't do before. So 5 seconds, the bad bits. It does hit, so you get to a point where you can no longer get fee reductions from managers. And so until you start doing things like insourcing, you do actually get to a point where you're no longer getting those scale benefits. Small exposures become meaningless. Constrained markets like microcaps, those sorts of things, you can't participate in those. And we do a derivative overlay around active asset allocation. Becomes very, very hard in constrained markets like, share price index futures, for example, which is not particularly liquid. So there are real challenges, but the key, I think, is in either case, recognising your competitive strengths and recognising the challenges and then playing to them. Thanks, Anne.
Thank you. Now, I'll let the audience questions go first because it's a very cheeky question here and sort of one after my, then I like cheeky questions. So it says, sounds like FSS, First State Super, has increased cost, larger budgets. Why? Isn't that just spending more because you can?
Absolutely not. It's to deal with the challenges of superannuation, which is agency risk, information asymmetry, the fact that we can't get scale benefits back to members. By actually increasing our internal budget, we are decreasing the costs that we spend on external fund managers. And ultimately, not only are we getting closer to the assets and hopefully making better decisions that are aligned to the outcome that we're trying to get for members, but we're actually doing it at an overall lower cost for members.
Okay, so this might be one for the whole panel. I'm going to go to the questions on the screen. So the first one is, what firm proof is there that scale or size directly leads to better decisions and outcomes? Did you find anything about that, Raywin, in your research, that, scale leads to better decisions or outcomes? Because Richard will say yes, it does, and Robin will say I'm not sure.
I think about, I picked up on Richard's comments about agency costs being reduced by being able to bring more things in-house, but it did actually raise a question in my mind, is the other way to get there to actually better manage those agents, if you like, so that you get alignment through your external providers. So that's actually, I guess, answering that question with the question.
Do either of you want to comment on that one?
Yeah, I will. This is premised on the fact that a smaller fund can't get the information that it needs to make better decisions, and I refute that very strongly. We may get our information from different venues, and that's where we have partnerships. But also, technology is at a point now where it's very simple for us to be able to do and have the knowledge and so forth. Richard talked about the systems that they've put into place to manage and measure and monitor all of their asset bases. We're the only ones who've got all of our portfolio holdings online. And we also have technology and systems to be able to utilise that and to be able to look at the risks and so forth. So I think it's about, again, goes back down to how are you getting information and how are you utilising that for decision making. And I think we're in the age of information overload, that there is never going to be any issues around that size.